Hello everyone, welcome to this short video where I will be talking about Tesla's introduction into S&P 500 and some trading strategies that I am considering. The video will go over the strategies and also provide you some free tools that you can use to play around and see which strategies work out for you in terms of this upcoming Tesla's introduction into the S&P. All right, so let's get started. Background, in case you don't know, Tesla will become part of the S&P 500 index. It'll take place on December 21st. So after the introduction, so obviously some companies are going to be kicked out from the S&P 500 index and Tesla will take place. And then the weight of Tesla is going to be somewhere around 2 to 3%. And it will obviously grow based on what happens after its introduction. Okay, so some strategies that I'm considering, and you can check it out. So there are a couple of actually there's more than 10 tickers that you can trade for this around this event. So you can obviously trade Tesla, just a Tesla stock. You can trade S&P 500 index ETFs, and then you can also trade with volatility exchange traded products. So I'll go over what they are if you don't know already, but the trading strategies are, you can obviously just buy shares, the most simple thing possible. That's probably pretty long term. If you don't get rid of them, you can still keep them. You can do a long call, and hopefully that's long enough that you can it'll cover these events that are upcoming. You can also do a bull call debit spread. Obviously bull call debit spread will be much cheaper than long call, so that's why I'm including it. And then you can do short put, where you'll collect premium, and then, or you can also do bull put credit spread. Very similar again, but significantly less risk. Okay, so I just want to show you the tools. If you click here, research tool, it will open this tool where you can search stocks, and then you can have an ETF list. So I already have how many, like 6 S&P 500 index ETFs listed here already, and then these are the volatility ETPs, or I think some of them are ETFs, some of them are ETNs. Actually, so before I go over the trade strategies, let me show you what the volatility ETFs look like, or what they do. So they essentially, whenever there's a lot of volatility, their prices go up. So I'll give you an example. So this one is VIX XVZ. If you look, actually, let's not, I don't think I have that on the list, do I? No, I don't. Let's look at one of these that I have on the list, VIXY. I think I picked up a couple of VIXY just to check out what's going on. Yeah, I picked up like 10 contracts. So if you look in 1 year chart, as you can see, around March, when the market crash happened because of coronavirus, there was tremendous amount of volatility, and because of that, there's this insane rise from $11. It went up to $56 within like a month, and then it started going down as the market started recovering and people weren't looking for as much protection. If you want to know more of the inner workings of how volatility ETFs work, they're all focused around the volatility index, and it's all about the demand for put options and call options. So I think over the next few weeks this will go up significantly, because Tesla is such a large company, and it getting introduced into the S&P 500 index is a huge thing, because so many people hold index ETFs, and a lot of people's retirement accounts also include index ETFs. So, and they are going to have to incorporate Tesla shares. So this will have a large impact, and I believe we're gonna see a lot of volatility in the upcoming weeks. Okay, so let's go over the strategy I mentioned in the earlier page. So long call, let's go to Tesla. Obviously you can just go buy call and just buy whatever you want, in the money or out the money, depending on how much money you want to spend. But as you can see, they're very expensive for the upcoming weeks. For this specific event, you want to buy something that's got at least 2 weeks of expiration length. And then if you want to buy a bull call debit spread, you could click the second tool, which is my option playbook. All the option tools are here, so you can find out how to form how to form a call debit spread. What you would do is put the ticker here, and then as you can see, the stock price is here, and you would sell a call that's above the stock price and buy a call that's below the stock price, and you would put how much money you're putting into it. Then it will tell you how much will be your max profit, how much will be your total loss, and whatnot. And then short put, very simple. You just sell a put that's very out of the money. If you do have to put significant amount of collateral, because if the stock plummets and your put becomes in the money, Robinhood will use your collateral to issue you these shares. So your cost will be of owning those shares will be your collateral minus the premium you collected when you sell the put. For bull puts, for bull put credit spread, you do the same, except you also buy a put. Let's go over that. So you sell a put, but you also buy a put that's under the put you're shorting. This way your cost, your maximum loss, or the collateral you have to put up is much smaller. So you will know what will be your maximum loss. Your maximum profit is the credit you're collecting. You hope that the put credit spread expires worthless, and you get to keep the premium you collected. So yeah, but that's pretty much it for this video. Let me know if you have any questions. Again, if you click these two links, you will be able to access both of the option playbook and the research tool. That is it. Thank you for watching.